In this week's video, we'll review the latest charts and data to help us answer the question, is a post-election euphoric peak just around the corner? Quote on the bottom of your screen is from Yardeni Research. Donald Trump's win and the Republicans' possible sweep of the House and the sweep of the Senate is consistent with our roaring 2020 scenario. Indeed, it increases the odds that good times will continue through the end of the decade and possibly into the 2030s, which of course aligns with, rather than contradicts, the thesis that we're currently in a demographically induced secular bull market that could last until 2035. Now, the upper left quadrant of your screen from Ryan Dietrich talks about the fact that the Fed rate cut this week was a rare event, with the Fed cutting near an all-time high in the S&P 500. They've done it 20 other times, and a year later, stocks were higher in every case. Ryan's table over here, average gain a year later, 13.9%. The median gain just a hair under 10%. And again, there were 20 historical cases. 20 times the market was higher a year later. Something similar just happened on Thursday of this week. And of course, none of this predicts anything. It just helps us better understand the probability of good things happening relative to the probability of bad things happening, allowing us to keep an open mind about better than expected outcomes, looking out 1 to 10 years, while keeping realistic expectations about how markets operate in the real world. Even if something like this happens, there is an extremely high probability that between a point A and a point B that could be 10 years down the road, there's going to be several events that are highly uncomfortable as we experience 100% normal and to be expected drawdowns. Here's one example of the numerous charts that we covered in last week's video that told us to keep an open mind about better than expected outcomes after the election. And from a leadership perspective, it's good to keep in mind, in 2016, the last time Trump was elected president, RSP outperformed SPY significantly for a short period of time after the election. If we zoom in on these two periods, 2016 and 2024, and in each case, look at RSP, the equal weight S&P 500 relative to SPY, the standard weight S&P 500, on a weekly chart, and we're doing so 2 days after the election in 2016 and 2 trading days after the election in 2024. You can see the RSP-SPY ratio had been rising for quite some time heading into the election with a multi-month period of consolidation. It's not really what we've had over the exact same time frame. This is January of 2016. This is January of 2024. You can see the ratio has moved from this point here earlier in 2024 down here. That's a downward sloping line indicative of a downtrend. In 2016, it was an upward sloping line indicative of an uptrend. And in both cases, we're speaking to the trend on an intermediate term multi-month time frame. Also noteworthy, this is 2 days after the election in 2016. The chart is dated November 10th, 2016. RSP went on to outperform for a few weeks after the election, and then it had a give back. And after that, quickly reverted to underperforming again in Q1 of 2017. Simply telling us not to overreact to movements in asset class behavior and leadership over the next, let's say, 1 to 4 weeks. This is the chart 2016, 2 days after the election. This is what the same chart looked like year-end 2016. And this is what the same chart looked like on January 26, 2018. Why did we pick that date? That's the day the S&P 500 peaked. That was the end of the Trump rally that began on Election Day in 2016 and again ended in January of 2018. And then 2018, stocks experienced 2 drawdowns and then a lower low in the second drawdown in Q4 of 2018. The charts on your screen are weekly charts with the 10-week moving average in gold, the 20-week in black, the 30-week in blue, the 40-week in red, the 50-week in green, and the 200-week in pink. And if we remove price, it's a little easier to compare and contrast both of the charts 2 days after Election Day in 2016 and 2 days after Election Day in 2024. You can see this is a much weaker trend here with these moving averages well below a downward sloping 200-week in pink. It's not really what we had here closer to Election Day in 2016. Now we're going to take several charts. One example is the chart on your screen that we've used in previous videos, charts that have been helpful, allowing us to stay with the bullish trend, and then eventually we'll take the charts and update them and see what they look like in the present day. Chart on your screen dated December 13th, 2023. It's almost a year ago. Covered this chart in one of our weekly videos. It told us to keep an open mind about better than expected outcomes. How does the same chart look today? Is it starting to deteriorate in a concerning manner similar to Q1 of 2022? It is not. The bullish breakout that we covered back here is still in place, and we're still well above this high here from 2021. Top portion of your screen is the Nasdaq Composite Tape Index. If you look at the upper right-hand corner, it's 2024. You can see the indicator crosses over the Bollinger Band here in 2024, similar to 1991, 1995, 2009, and 2016. You can see we're crossing here in 2024 after crossing below the center line on the Bollinger Band, remaining below it for quite some time, and then recapturing it. Since most of us know stocks performed well walking forward from 2009 and 2016, it might be helpful to look at the S&P 500 in isolation in 1991 and 1995, since the present day has a similar look. So here's the chart that we just looked at, a portion of that chart. We get the cross here in 1991. You can see the S&P 500 performed extremely well between 1991 and the end of 1993. Here's the second look here that's similar to 2024 using the indicator from the previous chart, the data from the previous chart. This is 1995. This is the S&P 500 walking forward from January of 1995. Both of the charts show the trends with price removed, and you can see they were strong trends, with gold the fastest moving average on top here in 1993, and pink the slowest moving average on the bottom. Here's a chart that we covered several weeks before the election on October 15th, 2024. We said the present day, upper right-hand corner of your screen, 2024, looked a lot more like 2016 and a lot more like the bullish setup in 2013 relative to these concerning setups in 2008, 2011, 2015, 2018, and 2020. How does the exact same chart look today? Is it morphing into one of these concerning looks? It is not. If we zoom in using the same data on November 7th, 2024, you can see we're trying to break out above this high here from 2021. Similar to this breakout here in 2013 and similar to this breakout here in 2016. And if you know your stock market history, 2013, 2014 into May of 2015 was a constructive period for equities. The same can be said here from relatively early in 2016 to that January 26th peak, 2018 in the S&P 500. Several weeks before the election, the S&P 500 advanced decline volume line weekly told us to keep an open mind about better than expected outcomes, with 2024 looking similar to this constructive setup in late 2016 after the first Trump election, successful election, and similar to this breakout here in 2013. This is a chart in the present day. If we fast forward, starting to take on a concerning look similar to Q1 of 2022 here, the answer is no. Chart on your screen, this version of it is dated November 7th, 2024, and we are holding that constructive breakout. Several weeks before the 2024 election, we also used this chart dated October 16th of Nasdaq new highs minus new lows to try to help us keep an open mind about better than expected outcomes. This was a constructive, different, incremental changing look here in mid-October, and we still have a constructive look on November 7th, 2024. If we go back to June of this year, June 7th, 2024, the date chart on your screen of BKLN in the ETF world, leverage, aka risky loans. We said the present day in June up here really didn't look anything like this concerning risk-off period during the COVID plunge or anything like this concerning risk-off look here in early 2022. Is this chart starting to deteriorate in the present day? The answer is no. Clients and longtime viewers know that we do cover Bitcoin from time to time because it can help us understand the market's tolerance for risk. This is Bitcoin relative to the US dollar. This is a monthly chart with the 7-month moving average all the way out to the 52-month moving average in pink here. Moral of the story, when the monthly chart of Bitcoin broke out to new highs here in early 2016, finished this period of consolidation and broke out in 2020, good things happened in the S&P 500 for a long period of time. In both cases, the market continued to rally for approximately 1 year. If we move to the upper right-hand corner of the screen, you could call this somewhat of a cup and handle pattern, which is a bullish pattern, or you could say that this is a left shoulder, this is the head, and this is the right shoulder, which would be potentially a constructive inverse head and shoulders pattern. Regardless, this is a long-term period of consolidation, and now we're trying to break out in a bullish manner, and we have a constructive profile with the moving average cluster as well. You can make an argument that this look here looks similar to this look in here and similar to this look in here. Again, several weeks before the U.S. election, we said, don't go to sleep on the Nasdaq. It looks like momentum is trying to turn up in a constructive manner. If we fast forward to 12:53 p.m. Eastern Time on Friday, November 8th, you can see we do have a MACD bull cross similar to this cross here, and this cross down here in late 2022. During the session on Friday, the Nasdaq Composite was up 5.68% for the week and breaking out of this multi-week period of consolidation down here. Again, looking at the weekly chart during the session on Friday, November 8th, we have a constructive candle here trying to clear these levels here from a few months ago, and constructive momentum profiles with Williams percent R on the weekly chart, MACD, and stochastic RSI. All of this over here really doesn't look anything like these concerning momentum looks here in late 2021 into January of 2022. All of this consolidation in recent months is occurring above an upward sloping 200-week moving average in red. If we look at the daily chart of the Nasdaq, top center portion of your screen during the session on Friday, November 8th, now we've got the 8-day moving average out to the 50-day moving average in gold. We've been showing this chart on Twitter and in these weekly videos to say that things have incrementally been improving on the Nasdaq for several weeks since we made this intraday low here, I believe, on August 5th. We still don't have full resolution here relative to leadership, but this is an improving look with the Nasdaq outperforming the S&P 500 by 0.9% during Friday's session. And you can see momentum down here with the Copic curve is trying to turn back up. During the session on Friday, we had price above all of the moving averages. That's the 30-week, the 40-week, and the 50-week. Slopes of all of the moving averages are up. Fastest moving average in blue is on top. The slowest moving average in green, the 50-week moving average, is on the bottom. Thus, we are trying to reestablish a full-bore bullish look, but there's still work to do. We would feel more comfortable about the Nasdaq resuming leadership if we could exceed this high here from July of 2024. Just a quick heads up, Schwackel Capital does not have a WhatsApp account, and we do not conduct any business on WhatsApp. Be careful of imposters and scammers. If you do have a message that implies that Schwackel Capital Management is recommending anything on the WhatsApp, it would be great if you could tag that message and report it. Chart on your screen, November 8th, 1 p.m. Eastern Time. We've shown this chart numerous times in recent weeks. We've said all of this consolidation in here has been occurring above this long-term period of consolidation in here. This looked healthy. It still looks healthy. We've got the 50-day moving average in blue on top, the 250-day moving average in silver on the bottom. The daily chart has a full-bore bullish look, and it's holding a wonderfully looking and constructive bullish breakout. The longer a market goes sideways, the bigger the move we can expect to get. We either get a bullish breakout or bearish breakdown, and of course in this case, we have a bullish breakout. Let's talk a little bit more about leadership. This is the Dow Jones Industrial Average, affectionately known as the Dow relative to the Nasdaq Composite. Chart is as of 1:05 p.m. Eastern Time on Friday, November 8th, 2024. Weekly cloud for the ratio. If you're a Dow bull, these are the bullet points you want to avoid. Bearish odds increase when green is below price. It is. When price is below the cloud. It is. When the cloud flips from green to red, well, it's still red. When price is below red, in this case the ratio is below red. And when blue is below red, well, blue just crossed below red. We're checking this box, this box, this box, this box, and this box. Telling us from a leadership perspective, the Dow has some work to do to overtake the Nasdaq Composite. And when the Nasdaq was consolidating in September of this year, chart on your screen dated September 24th, we used this chart to say, yes, this looks weak in here from a momentum perspective, but the trend still looks good. Looks like we're trying to make a stand here at an upward sloping 40-week moving average in red. And momentum looked like it was trying to turn back up in September of this year, similar to this turn here near the October low in 2023. Also making a stand above an upward sloping 40-week moving average in red. How does the exact same chart look today? Better, worse, or about the same? The answer is better. We're above this level here. And better, we do have a more constructive turn here in the True Strength Index. Several weeks before the election, we said, this chart is telling us to keep an open mind about better than expected outcomes. NYSE Composite Monthly checking all of the bullish boxes and looking similar to constructive periods in 1991, 1995, 2012 after the major low in 2020, and after a period of indecisiveness here from 2023. If we look at the same chart on November 8th, 2024, 10 minutes after 1, we still have a very constructive look, and we continue to check all of the longer-term bullish boxes. This is the monthly cloud chart for the NYSE Composite. October 17th, 2024, just a few weeks before the election, we used this chart to say, try to remain patient here and keep an open mind about better than expected outcomes, because the present day here looks similar to 2003, 2009, 2016. Good things happened in the S&P 500 following similar setups. In this case, we use the 20-month moving average in blue, but you can see the same concepts in the present day if we switch over to the 50-month moving average on November 8th, 2024. On September 24th, just a few short weeks ago, we said keep in mind all of this consolidation here is occurring above an upward sloping 30-week moving average in blue, an upward sloping 40-week moving average in red, and an upward sloping 50-week moving average in green. If we zoom in using the same moving averages, we still have a constructive and strong trend. Look, the only difference is this consolidation that we talked about back here in September is for the most part in the rear view mirror as of November 8th at 1:23 p.m. Eastern Time. Also noteworthy, this is a strong trend look for the broad S&P 1500. And even with this strong trending look, If we compare that same index to the Nasdaq composite and put a 200-week moving average on it here, you can see in 2024 on November 8th, really haven't done anything yet to flip this longer-term downtrend. We are near the moving average here, so we have to keep an open mind. Probabilities would improve if the ratio can move into this area here. During the session on Friday, November 8th, around 1:20 p.m. Eastern Time, the S&P 1500 was underperforming the Nasdaq by 0.77%. November 9th, 2023, we said all of this consolidation here was occurring within the context of a very constructive setup here when we looked at the monthly chart of the S&P 500. This looked similar to this setup here in 2016. How does the exact same chart look today? Is it morphing into something more concerning like this look here in 2015 or this look here in Q1 of 2022? It is not. We still have a constructive long-term look on Friday, November 8th at 1:26 p.m. Eastern Time. In June of this year, we said from an intermediate-term perspective, it was a good sign that momentum indicators on the weekly chart of the S&P 500 using Williams percent R, stochastic RSI, and full stochastic, these looks really didn't look anything like these concerning looks here during the corrective period in 2023. Chart on your screen again is dated June 7th, 2024. Are we starting to lose momentum similar to these concerning looks here from the summer of 2023? If you go to the far right portion of your screen, lower half here, the answer to that question is no. This, and this really don't look anything like this concerning period in here during the correction in 2023. Given what we know today, it's quite possible that our number one job in the coming weeks and months will be to fight complacency. Make sure that we don't get overconfident. When you look at things like the VIX and you look at margin debt, it appears, given the strong trends that we have, that the stock market most likely will continue to move to the upside from a trend perspective in the coming weeks and months. But we don't want to make any assumptions. And even if really good things are going to happen for a long period of time, it's extremely important that we have realistic expectations about how markets operate in the real world, even in the context of a secular bull market. The charts and concepts covered in these weekly videos over the past year, fortunately, have been very helpful. But we all know the only way that we can use them effectively going forward is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.